The envelope arrives in the mail, and the number inside does not make sense at first. The premium that was $2,000 last year is now $4,000. Or the letter is not a renewal notice at all. It is a non-renewal notice, informing the homeowner that coverage will end in 60 days and that the insurer will no longer be offering policies in their zip code. This is the experience that hundreds of thousands of California homeowners have been living through since 2023, and the situation accelerated dramatically after January 2025, when a series of wildfires swept through Los Angeles County and changed the financial calculations of the entire California insurance market in ways that are still working through the system today. To understand where California's homeowners insurance market stands in 2026, it is necessary to understand what happened before the January 2025 fires and what those fires added to an already deteriorating situation. The underlying dynamics that created the crisis were years in the making. California's insurance market operates under Proposition 103, a ballot measure passed in 1988 that requires insurers to get approval from the State Department of Insurance before raising rates. For decades, this framework was described by consumer advocates as a protection against excessive pricing. For insurers, particularly after the wildfire years of 2017 and 2020 through 2022, the framework became a reason to exit the state. Proposition 103 originally limited insurers to setting rates based on historical loss data, what fires had actually cost in the past, rather than forward-looking models that project future risk under changing climate conditions. As wildfire risk increased, insurers argued that historical data systematically underestimated what losses would cost going forward. Unable to price risk at levels they considered actuarially sound, major carriers began restricting new policy sales, not renewing existing customers in high-risk areas, and in several cases withdrawing from the California homeowners market entirely. State Farm, California's largest homeowners insurer with more than 1 million homeowner customers and 2.8 million total property policies in the state, announced in March 2024 that it was non-renewing more than 30,000 homeowner and condominium policies statewide, including more than 1,600 in the Pacific Palisades and more than 2,000 in 2 other Los Angeles zip codes, including Brentwood, Calabasas, and nearby neighborhoods. Allstate, Farmers, and several other major carriers had already taken similar steps in prior years. The cumulative effect of these market exits was a rapid increase in the number of homeowners with nowhere to go except the California FAIR Plan, the state-chartered insurer of last resort that exists to provide basic fire insurance to property owners who cannot find coverage in the private market. The FAIR Plan was designed as a temporary backstop for a limited number of very high-risk properties. It was never intended to function as a primary insurer for hundreds of thousands of California households. By September 2025, the FAIR Plan had reached a record 646,000 policies, nearly double its policy count from 2 years earlier, according to data reported by E&E News. The FAIR Plan was processing more than 17,000 new applications every month, as private insurers continued to issue non-renewal notices. The plan's president, Victoria Roach, had warned a state assembly committee in 2024 that the plan was one major event away from exhausting its funds. That event arrived in January 2025. A series of fast-moving fires swept through Los Angeles County beginning on January 7. The Palisades Fire burned more than 23,700 acres and leveled neighborhoods along the coast. The Eaton Fire struck Altadena and surrounding areas. Together, the January fires killed 29 people, forced tens of thousands to evacuate, and destroyed more than 12,000 structures. An analysis by AccuWeather estimated total expected damage, including economic impacts, at between $250 and $275 billion. Insured losses to the property and casualty industry were estimated by Risk and Insurance magazine at a record $40 billion from the Los Angeles fires alone. The FAIR Plan ran short of funds almost immediately. By early February 2025, Insurance Commissioner Ricardo Lara approved a $1 billion assessment levied against all insurers licensed to sell property insurance in California, with each company's share calculated based on its market share. State Farm's assessment, as the largest insurer in the state, exceeded $165 million. Under new regulations that had taken effect as part of Commissioner Lara's sustainable insurance strategy, insurers were permitted to recoup up to 50% of any FAIR Plan assessment by passing costs to their own policyholders through a temporary fee added to premiums. State Farm announced it would add a supplemental fee of 1.13% of annual premium per renewal for homeowners and rental dwelling policies over 2 renewal periods, beginning December 2025 for personal lines and January 2026 for commercial lines. This meant that State Farm customers who had nothing to do with the Los Angeles fires and lived nowhere near the affected areas began seeing higher bills at renewal, specifically because the FAIR plan needed additional capital to pay claims from those fires. The January fires also accelerated rate increase requests that were already in the pipeline. State Farm received approval in May 2025 for an emergency interim rate increase averaging 17% on approximately 1 million homeowner policies, a response to over $7.6 billion in projected payouts from the January fires, a figure that nearly doubled the company's previous highest single-year losses in 2020. The approval came with conditions. State Farm's parent company injected $400 million in additional capital into State Farm General, the California entity, and the company agreed to pause additional mass non-renewals through the end of 2020. Mercury Insurance and CSAA Insurance each received approval for 6.9% rate increases under the state's new framework, with commitments to expand their coverage in wildfire-distressed areas. State Farm has subsequently requested an additional 22% average increase, with that request under review. The California FAIR Plan itself filed a proposal with the Department of Insurance for permission to raise its own rates by an average of 35.8%. The request, if approved, would take effect on the first renewal date after April 2026. The increases are not uniform. The FAIR Plan's filing indicates that approximately half of its policyholders would see premium jumps of 40 to 55%, with some properties in the highest risk areas facing increases of up to 78%. 4 properties in the FAIR Plan's portfolio were projected to see increases of 300%. The reason for the magnitude is that the FAIR Plan is for the first time being allowed to use forward-looking wildfire catastrophe models, the same class of models that private insurers had been requesting permission to use for years, rather than relying solely on historical loss data. The state's completion of its review of 3 wildfire catastrophe models in mid-2025, under the Sustainable Insurance Strategy, unlocked this methodology for both the FAIR Plan and private carriers filing new rate requests. Commissioner Lara's Sustainable Insurance Strategy represents the state's most significant regulatory overhaul of the property insurance market since Proposition 103. Its central bargain is this: insurers that use department-reviewed wildfire catastrophe models and commit to maintaining coverage in wildfire-distressed areas will be permitted to set rates that reflect forward-looking risk projections rather than only historical losses. Under previous regulations, insurers could raise rates based on past data, but were not required to maintain coverage as a condition of operating in the state. The new framework requires insurers using the catastrophe models to write and maintain policies in high-risk areas, a commitment that the Department of Insurance describes as unprecedented in California's regulatory history. Mercury Insurance, Allstate, and CSAA were among the first carriers to announce they would make rate filings under the new system and plan to expand their California footprint in response. 9 new laws sponsored by Commissioner Lara took effect on January 1, 2026, designed to complement the Sustainable Insurance Strategy with consumer protections. The California Safe Homes Act established a new grant program to help qualifying residents obtain fire-safe roofs and implement fire mitigation measures within 5 feet of their homes, the zone considered most critical for ember resistance. The California Wildfire Public Model Act created a publicly available wildfire risk model intended to help homeowners and communities understand their risk exposure independent of insurer proprietary assessments. The Insurance and Wildfire Safety Act requires the Department of Insurance to regularly review and update its Safer from Wildfires regulations as wildfire science advances. A separate provision requires insurers to pay 60% of contents coverage limits, capped at $350,000, to wildfire survivors immediately, without requiring a full itemized inventory of lost belongings, a response to widespread complaints about claims delays that followed the January 2025 fires. According to the Department of Insurance, insurers had paid more than $22.4 billion in claims from the Los Angeles wildfires as of early 2020, with the department reporting it had returned more than $67 million to wildfire survivors through enforcement of consumer complaint investigations. For homeowners trying to navigate this market in 2026, The practical situation varies significantly depending on where they live and what kind of property they own. In areas that have not experienced significant wildfire losses and where private market competition remains, standard homeowners insurance is still available, though premiums have risen across the board as insurers spread risk regionally. In communities adjacent to wildland areas throughout the Sierra Nevada foothills, the North Bay counties, portions of Los Angeles County, and much of the coastline north of Santa Barbara, the private market has contracted sharply. Homeowners in these areas who receive non-renewal notices face a choice between the FAIR Plan, which provides basic fire coverage but does not include liability protection, water damage, or theft coverage that a standard homeowner's policy includes, or the surplus lines market, which is not regulated under Proposition 103, and can charge rates the insurer sets without prior regulatory approval. Surplus lines coverage can be substantially more expensive than standard admitted market policies, but provides more comprehensive protection than the FAIR Plan. The combination of FAIR Plan coverage with a difference in conditions policy, a separate supplemental policy from the surplus lines market covering the categories that the FAIR Plan does not, has become the standard workaround for California homeowners who cannot find admitted market coverage. The total cost of this two-policy approach in high-risk areas frequently exceeds annual premiums that homeowners in comparable housing in lower-risk states would consider extraordinary. Reports from homeowners in Sonoma County, the Sierra Nevada foothills, and parts of Los Angeles County describe combined annual insurance costs of $6,000 to $10,000 or more for properties that were insured 2 years ago for $2,000. The financial pressure this creates on household budgets is compounded by California's broader housing cost environment, in which mortgage payments, property taxes, and other ownership costs have all increased substantially over the same period. The FAIR Plan's expansion to 668,000 policies in 2026 represents a structural change in how a significant portion of California's housing stock is insured. Morningstar, in a report issued 1 year after the January 2025 fires, called those fires a significant stress event for California's property and casualty insurance sector, and noted that State Farm General, the entity writing California property risk for the State Farm Group, remained in a relatively weak, though stable, financial position, despite the $400 million capital injection from its parent. The report noted that State Farm's S&P financial strength rating was lowered to A-, with a stable outlook in August 20. A heavy reliance on the FAIR Plan as the default coverage option for high-risk areas continues to pose a risk for the industry. According to the report, because the FAIR Plan's financial exposure is backed ultimately by a potential assessment on the entire California property insurance market, and those assessments flow through to all policyholders statewide, not only those in high-risk areas. Governor Newsom's emergency declaration on January 7, 2025, triggered a mandatory 1-year protection against non-renewal or cancellation of residential property insurance policies in the Los Angeles County zip codes affected by the fires. A separate moratorium was issued in September 2025 to protect approximately 124,000 policyholders in Calaveras and Tuolumne counties, following a new wildfire emergency declaration in that region. These moratoriums provided immediate relief for affected homeowners, but they do not prevent rate increases and they expire. The transition out of a moratorium period and back into normal market conditions is a period of heightened risk for policyholders who have been protected from non-renewal, while the underlying insurance market dynamics that drove the original crisis have not fully resolved. Further developments are expected as the FAIR Plan rate increase request moves through the Department of Insurance review process, as additional carriers file rate applications under the new catastrophe model framework, and as the 2026 wildfire season and its effects on insurer financial positions become clear in the months ahead.